Hi, my name is Kiara Johnson, and I am a senior mortgage banker for First Integrity Mortgage Services located in St. Louis, Missouri. Today we are going to discuss the FHA mortgage loan and all that it entails. FHA qualifying guidelines are more flexible than those of most conventional non-government loans. However, not just anyone can qualify. You must have sufficient and stable income and show that you can responsibly manage debt. While you don't have to be a U.S. citizen, you do need to show that you're in the country legally and that the U.S. Citizenship and Immigration Services are likely to approve your continued residency. You'll need a minimum of 3.5% of the property's purchase price. You can save it, get it as a gift from a family member or a state or government agency. Please refer to my other video, Acceptable Down Payment Sources, for more insight. Did you know that you can even obtain an FHA mortgage without a credit score? You'll want to talk with your lender about non-traditional credit programs, as that is an option as well. You have to be able to prove your income. Income should be stable, meaning you receive it consistently and it's reliable. It should also be likely to continue for at least 3 years. Mortgage lenders generally assume that your employment will continue unless there is reason to believe otherwise. For example, a buyer works overtime but is sporadic. An underwriter may choose to use base income only and omit the overtime income. It would be used as a compensating factor but not as a qualifying factor. Another example, if a buyer receives child support but the child is now 16. It's hard to prove that the child will pursue college at this point, and if it's not specifically stated in the divorce decree or child support order that the support will continue, it cannot be used. Your new mortgage payment will include your principal, interest, property tax, homeowners, and mortgage insurance. All of your monthly bills, including house payment, credit cards, student loans, auto loans, etc., should not exceed 43% of your gross income. However, as stated before, FHA is a little more lenient. Lenders will let you go as high as 55% of your income in certain cases, but of course you need to have some compensating factors. For instance, money in the bank or investments. We have income that we're not using, strong credit, or etc. When underwriting for a government-backed mortgage like FHA, the lender must check a database of people who have defaulted on government debt, such as taxes and/or student loans. This database is called the Credit Alert Interactive Voice Response System, also known as CAVERS. In most cases, the check is just a formality. If your name turns up on a list, you won't be eligible for any government-backed mortgage until you resolve the matter. Qualifying for FHA financing is not cut and dry. Underwriters look at the total picture and may be more or less lenient depending on the overall strength of your application. In addition, not all lenders apply FHA guidelines the same way. Let's be honest, one's interpretation is not universal. Once you find a mortgage lender that you're content with, it's time for you to apply for your mortgage. Before I conclude, let's go over a list of documents that you'll need when you apply for your loan. Your earning documentation. For salary employees, that means your last 2 pay stubs and W-2s covering your most recent 2 years of employment. For self-employed borrowers, that means 2 years of tax returns and year-to-date financial statements. If you earn income from commissions, bonuses, or second jobs, you'll need to have received it for at least 2 years before it can be used to qualify for an FHA mortgage. Other income documentation. You can use Social Security, disability, pensions, child support, interest, or dividends to qualify for your mortgage. You'll need to prove that you get it regularly and that it will continue for at least 3 years. So what about unemployment compensation? There is one situation in which you can use unemployment compensation to qualify for a mortgage financing, and that's with our seasonal employees. Seasonal employees with a 2-year history of working and then collecting unemployment can count the employment compensation as income. This usually hits a majority of union workers and construction workers. Assets. Aside from your down payment and closing costs, FHA sets no minimum amount for assets. However, lenders like to see that you have savings to pay your mortgage payment if your income temporarily stops. To document your checking account funds, furnish your most recent 2-month statements, all pages, even if they're blank. For your savings account, investments, and retirement accounts, provide your most recent quarterly statement or your last 2 monthly statements. If you have joint accounts with someone who is not applying for the loan with you, get a letter verifying that you have access to 100% of the money in the accounts. Gifts. If someone gives you part or all of the down payment, you have to prove that it's a gift and that it comes from an acceptable source. FHA wants to be sure that you did not borrow the money or get a gift from someone who could benefit from the sale, like the seller, real estate agent, or your loan officer. You have to provide a gift letter and copies of statements proving that the money came from the giver. Miscellaneous items. If you pay or receive child support or alimony, you'll need to supply a copy of your divorce decree. You do not have to disclose your support payments received, but if you want to use them to qualify for your mortgage, you must prove the amount and duration. You'll also have to show that you receive it regularly and on time. Canceled checks or records of your deposits can take care of this requirement. When your loan is in process, avoid these mistakes. Do not make big ticket purchases on credit. Do not apply for new credit cards or take on other consumer debt. And please do not quit your job unless you are switching to a better paying one in the same field and your loan officer is aware. Your credit and employment will almost certainly be rechecked before your home loan funds. Anything that indicates your debt to income ratio has changed or that your credit score has dropped could get your loan approval revoked. Thanks for listening, and I hope this video was informative.